Welcome to the deep dive. Today we're going behind the scenes to explore managerial accounting.
Ooh, exciting.
You might be thinking, wait, isn't accounting all about taxes and spreadsheets? But get ready for a surprise.
Yeah, I think a lot of people have that impression.
We're diving into a college-level instructor manual,
Okay.
but trust me, this isn't your typical dry textbook stuff.
I hope not. I was a little worried when you said college-level instructor manual.
This deep dive is all about understanding how companies use managerial accounting to make decisions, allocate resources, and ultimately achieve their goals.
It's like cracking the code of how businesses really operate.
Exactly. And the best part is you don't need to be an accounting whiz to follow along. We'll break down the complex concepts into bite-sized pieces using real-world examples. So first things first, what exactly is managerial accounting and how is it different from financial accounting?
That's a great place to start. Financial accounting focuses on reporting a company's financial performance to external parties. So we're talking about investors, creditors, regulators, the government, all that. But managerial accounting, that's all about providing insights to internal decision makers.
So if financial accounting is like a company's public report card, then managerial accounting is more like their internal strategy playbook.
Precisely. It's about using financial data to guide decisions related to things like product development, pricing, production, resource allocation, all the things that keep a business running smoothly.
Okay. I'm starting to see the distinction here.
Yeah.
But how does this play out in a real company?
Well, imagine a company as a tree.
Okay.
The instructor manual uses this analogy of verticals and horizontals to illustrate a typical company structure. The verticals are like the branches of the tree. Each one represents a different department or business unit focused on a specific product or service.
So if we're talking about a tech company, one vertical might be focused on software development, another on hardware, another on cloud services.
Exactly. And then you have the horizontals. They're like the roots of the tree, providing those essential support functions across all the verticals.
Okay.
Things like finance, human resources, IT, legal, the functions that keep everything running smoothly.
So how does managerial accounting fit into this whole tree analogy?
Well, managerial accounting provides the financial data and insights that help each branch, each vertical, make informed decisions about how to grow and thrive.
Okay.
And it also helps those horizontal departments operate efficiently and support the overall growth of the company.
It sounds like managerial accounting is involved in pretty much every aspect of a business.
It really is.
Yeah.
In fact, the manual highlights 4 key functions of the management process, all of which rely heavily on managerial accounting:
And what are those?
strategic planning, measurement, evaluation, and control.
Let's break those down. Strategic planning, that sounds pretty high level.
It is. Strategic planning involves setting those long-term goals for the company and figuring out how to achieve them. This could include decisions about, expanding into new markets, developing new products, or investing in new technologies. Managerial accounting helps provide those financial forecasts and analysis to guide those strategic decisions.
So it's like looking ahead and saying, okay, if we want to achieve this goal in 5 years, what financial resources do we need and what kind of returns can we expect?
Right. Then you have measurement, which is all about tracking key performance indicators, KPIs, to see if the company is on track to meet those goals.
Right.
Managerial accounting provides the tools to collect and analyze this data, giving managers a clear picture of what's working and what's not.
And then comes evaluation, right? Making sense of all that data.
Exactly. Evaluation involves comparing actual results to planned results. Managerial accounting helps identify areas where the company is exceeding expectations and areas where they might need to make some adjustments.
And this is where control comes in.
You got it. Control involves taking action based on those evaluations. It could mean tweaking a marketing strategy, adjusting production levels, or even revisiting those long-term strategic plans. It's all about using the insights gained from managerial accounting to make the necessary course corrections.
I see. So it's a continuous cycle of planning, measuring, evaluating, and controlling with managerial accounting as the guiding force. This is giving me a whole new appreciation for what goes on behind the scenes in a business.
Yeah, it's really interesting when you start to peel back the layers.
The manual uses this fictional company called Legend Guitars as a case study to explain some of these concepts.
I love guitars.
Let's dive into the world of manufacturing and see how managerial accounting plays out there.
A perfect example, because crafting a guitar involves a blend of raw materials, skilled labor, and those often overlooked but crucial overhead costs.
Before we get into those details, the manual mentions this term cost object. What exactly is a cost object, and why is it so important in managerial accounting?
In the simplest terms, a cost object is anything for which a company wants to track costs.
Okay.
It could be a specific product, like one of Legend Guitar's handcrafted masterpieces, a particular service offering, a department, or even a whole project. Identifying the cost object is crucial because it determines which costs are directly associated with it and which are indirect. This distinction is essential for accurate cost accounting.
Okay, so let's say our cost object is one of Legend Guitar's beautiful acoustic guitars. What are some examples of direct and indirect costs that would go into making that guitar?
Well, the direct costs are pretty straightforward. These are the costs directly tied to the materials and labor used to create the guitar. So we're talking about the wood for the body, the strings, the tuning pegs, the electronics, and of course the wages paid to those skilled craftspeople who build the instrument.
And the indirect costs, those are a bit trickier.
Right. Indirect costs are those that are not directly traceable to a specific cost object, but are still essential to the overall production process. Think of things like the rent for the factory space, the electricity to power the tools, the cost of maintaining the equipment, even the property taxes on the factory building.
So while you might not be able to say this specific dollar amount of rent went into making this specific guitar, those overhead costs are still part of the overall cost of producing that guitar.
Exactly. And accurately accounting for those indirect costs, or factory overhead as it's often called, is crucial for a company like Legend Guitars to determine the true cost of each guitar they produce.
And why is that so important? What happens if they don't accurately account for all those costs?
That's where things can get tricky. If they underestimate their costs, they might end up setting prices too low, which could eat into their profit margins. On the flip side, if they overestimate their costs, they might set prices too high and lose out to competitors.
So it's a delicate balancing act, and accurately tracking all those costs, both direct and indirect, is crucial for making informed pricing decisions and ultimately staying profitable.
It's fascinating how those indirect costs, that factory overhead, can sometimes be the hidden culprit behind a business's struggles.
Yeah.
I've seen companies that meticulously track their direct costs,
Right.
but then they kind of gloss over those indirect costs, not realizing how much they can impact the bottom line.
It's like trying to bake a cake without factoring in the cost of the oven and the electricity to run it.
Yeah,
You might think you're making a profit, but then those hidden costs sneak up on you.
exactly. That's why it's so important to have a solid system for capturing and allocating those indirect costs. And speaking of costs, the manual delves into how these cost considerations play out in a company's financial statements.
Okay, financial statements. Now, I have to admit, this is where my eyes usually start to glaze over a bit,
Yeah, I get it.
but maybe you can help me see the light.
I'll do my best. Now, while balance sheets and income statements exist for all types of businesses, there are some key differences between those for manufacturing companies, like our guitar-making friends at Legend Guitars,
Right.
versus those for retailers or service businesses.
And I'm guessing those differences have something to do with the whole process of transforming raw materials into finished goods.
You're exactly right. The manual really emphasizes this concept of inventory for manufacturers.
Okay.
They don't just buy and sell products. They have this whole journey of materials moving through different stages.
Okay, so let's break down this inventory journey. What are the different types of inventory we need to keep track of?
Well, first, you have your raw materials inventory. This is all the stuff they have on hand but haven't yet started using. So for Legend Guitars, this would be all the wood, strings, electronic components, and other materials just waiting to be transformed into those beautiful instruments.
Then what happens? Does it just magically turn into a finished guitar?
Not quite. There's this in-between stage called work-in-process inventory. This represents all the guitars that are in various stages of completion. Some might have the body assembled, but not yet painted.
Yeah.
Others might be wired, but missing the neck, and so on.
It's like a snapshot of the production line frozen in time.
Exactly. And it's important to track the costs associated with each stage of production because those costs are accumulating as the guitar moves through the process.
And finally, we have the finished goods inventory, right?
You got it. These are the completed guitars ready to be shipped out to music stores or eager customers.
Okay, so we have raw materials, work in process, and finished goods. But why is it so important to track inventory so meticulously? What's the big deal?
It's all about understanding the flow of costs through the manufacturing process. By tracking inventory levels at each stage, companies can determine the cost of goods manufactured. which is a crucial figure for calculating their profit on the income statement.
So there's this whole other financial statement I've never even heard of, the statement of cost of goods manufactured.
It might sound intimidating, but it's really just a way to summarize all the costs that went into making those guitars during a specific period. It takes into account the beginning and ending balances of each inventory type, the cost of materials purchased, direct labor costs, and of course those ever-present factory overhead costs.
And this statement feeds directly into the income statement, which tells us how much profit they made.
Precisely. It helps paint a complete picture of the financial health of the manufacturing process.
This whole inventory journey is actually kind of fascinating. It's
Yeah.
like following the life cycle of a guitar from raw wood to a finished instrument and seeing how each step adds to the cost and ultimately the value of that guitar.
It is quite a journey. But remember, managerial accounting isn't just for manufacturers.
Right.
It's just as relevant for service businesses, even though they don't have physical inventory in the same way.
So how does managerial accounting play out in the service world? What kinds of things are they tracking and measuring?
Well, one key metric for service businesses is the utilization rate. This measures how efficiently a business is using its fixed assets to serve its customers.
Okay, fixed assets. That sounds a bit technical. Can you give me an example?
Sure, let's say you're running a hotel.
Okay,
Your fixed assets would include things like the hotel building itself, the furniture, the equipment in the kitchen, and so on.
right.
Your utilization rate would measure how much you're actually using those assets.
So if a hotel has 100 rooms and on a particular night, 80 of those rooms are occupied, then their utilization rate is 80%.
Exactly. And the higher the utilization rate, the better,
Right.
because it means you're squeezing the most value out of those fixed assets.
It's like making sure you're getting your money's worth out of those investments.
Right. And every empty hotel room represents lost revenue potential. The same logic applies to other service industries.
Okay.
Think of an airline with empty seats on a flight, or a consulting firm with consultants who aren't fully booked with projects.
So utilization rate is all about making sure you're operating at full capacity, or at least as close to it as possible.
Exactly. It's a key indicator of efficiency and profitability for service businesses.
This concept of utilization rate is really making me think.
Yeah.
What are some other examples of how service businesses might use this metric?
Well, let's take a transportation company, like a trucking company. Their utilization rate might be based on the number of miles their trucks are driven while carrying cargo versus their total potential mileage.
So the more miles they're driving with a full load, the higher their utilization rate and the more efficiently they're using their trucks.
Exactly. And then you have shipping companies like FedEx or UPS. Their utilization rate might be tied to the volume of packages they're delivering relative to the capacity of their trucks and planes.
And for a bank, maybe it's the ratio of loans they've issued to the amount of capital they have available to lend.
Precisely. You're catching on quickly. It's a versatile metric that can be adapted to a wide range of service businesses.
It's amazing how these managerial accounting concepts can be applied to so many different industries. I'm starting to see how it's really a universal language for understanding how businesses operate and make decisions. As we've been talking about all these different concepts, one thing that's been on my mind is this whole idea of corporate social responsibility, CSR.
Yeah.
Earlier we touched on how companies are increasingly being held accountable for their social and environmental impact. I'm curious how managerial accounting fits into that.
That's a great question, and one that's becoming increasingly important in the business world. It's not just about profits anymore. Stakeholders are demanding that companies consider the broader impact of their decisions on the environment, their employees, and the communities they operate in.
So how does managerial accounting help companies measure and manage those impacts?
Well, just like companies track their financial performance using various metrics, they can also use managerial accounting tools to track their CSR performance. For example, they can track their carbon emissions, water usage, waste generation, other environmental indicators. They can also track things like employee satisfaction, diversity and inclusion metrics, and their contributions to local communities.
It's like creating a whole new set of performance indicators, but instead of focusing solely on financial returns, they're measuring their impact on the planet and society.
Exactly. And what's interesting is that these CSR initiatives are often intertwined with cost considerations.
Okay.
For instance, investing in renewable energy might have a higher upfront cost, but it can lead to long-term savings and reduce the company's environmental footprint.
So it's not just about doing good, it can also be good for business in the long run.
Right. And managerial accounting can help companies quantify those benefits and make a stronger case for investing in CSR initiatives.
It's like using the language of business to advocate for a more sustainable and socially responsible approach.
Exactly. It's about bridging that gap between purpose and profit and showing that they're not mutually exclusive.
This has been such an eye-opening deep dive into the world of managerial accounting. We've covered so much ground, from the core difference between managerial and financial accounting to how companies track costs, manage inventory, and even measure their social and environmental impact. Before we wrap up, I'd love to hear your take on what the future holds for managerial accounting. Where do you see this field heading?
Well, that's a great question to ponder. I think one of the most exciting trends is the increasing integration of technology into managerial accounting.
Yeah.
With advancements in data analytics and automation, companies can now gather and analyze vast amounts of data in real time. This allows them to make more informed and agile decisions, identify potential risks and opportunities more quickly, and ultimately optimize their performance in ways that weren't possible before.
So it's like giving managers a superpower, the ability to see the inner workings of their business with incredible clarity and precision.
Precisely. And I think this data-driven approach will continue to shape the future of managerial accounting. It will enable companies to not only track their financial performance, but also measure their impact on the world in a more comprehensive and meaningful way.
As we conclude this deep dive, I want to leave our listener with a final thought. We've explored how managerial accounting is like a secret decoder ring for understanding the language of business, but it's more than just crunching numbers. It's about using those numbers to make informed decisions that drive success, not only for the company, but for its stakeholders and the wider world.
Well said. It's about recognizing that business decisions have ripple effects, and managerial accounting can help us understand and manage those effects in a way that creates value for everyone involved.
Thanks for joining us on this fascinating journey into the world of managerial accounting. We hope you've gained some valuable insights and are inspired to keep exploring. Until next time, keep seeking knowledge and diving deep.